we've been doing this virtually for quite some years now. So welcome everyone who's here in person. I know it doesn't give me the greatest angle online, so it's sort of my chin is quite prominent in this particular angle, but lucky I've got a strong chin at the moment. Anyway, I'll assume that everyone's read the disclaimer and are okay with me moving forward. And whilst we'll continue to read the slide, there may be a lot of stuff that we're repeating, hopefully some consistent themes that you're hearing, and we can consistently deliver on our promises. So year in review, it's certainly been it's been a year of revenue growth and new business wins, highlighted at the very top of the list of things we're very proud of this year. We've strengthened our board and management team. We've made a successful acquisition, and we continue to drive technology within the business as a leading factor, not only driving new business, but operational efficiency within our current business. So achieved the first ever $10 million revenue quarter in Q1 of FY24. We're on track to meet previous FY24 guidance at the top range in both the areas of revenue and also underlying profitability. That guidance was $39 to $41 million in terms of revenue. So we're at the very top end of that. And the guidance in terms of profit was $1 to $2 million. So certainly at the top level of that, being 4 months into the financial year. We've had strong digital growth across the software as a service platform, up 26% quarter on quarter in FY24. We're also very excited and proud of the tender success rate, where we're still winning over 70% of all tenders. We'll go into more detail about what's driving that, but the digitally led process supported by our servicing business and Armour Group is predominantly the reason why we're being successful within the areas of utilities, essential services, banking and insurance. We're well capitalised with $12.2 million cash available in the bank to support onboarding tier one clients, which we know sometimes takes some time and can be expensive, but it's absolutely investment we want to make to ensure our future growth. We've undertaken a significant investment in our IT security. Once again, as you go into that tier one market of looking after big four banks, large insurers, large utility companies, what the expectation is, not just in the current environment, but in any environment, that we've got the systems, processes and controls in place to ensure that we have the highest levels of data security and protection for the vast amount of private data that we hold for our clients and on their customers. We acquired DRA Group, which consisted of a specialist insurance collections business, a legal firm, once again specialising in the insurance space, and a BPO business called Nova, which operates in the Philippines, that drives operational efficiency through offshoring some activities. So we're sort of very pleased with that acquisition, not just because it's generating profit and cash from day one, but the synergies between the businesses are very strong. One of the main reasons why we were able to do the deal with the owners of DRA Group was they recognised the need to take their business from an analog business to a digitally led business, as there's huge amounts of digital transformation happening at the moment. So it not only strengthens our capability, there's huge synergies between that organisation as ours to drive up, gross profit margins, profitability, expand their offering to existing clients through the digital software as a service solutions that we provide. It feels like a little while ago, but we appointed Paul Dwyer as chairman, and also strengthened the management team, or by appointing Paul Dwyer, that might have strengthened the management team, I hope. So there's lots of stuff been going on and stuff that should give encouragement that despite the share price languishing a little bit or going the other way, the business is in a far better position than what it was this time last year, as I stand before you and present this presentation. Apologies to those who have heard this and seen this slide on a number of occasions, but there's quite a few, individuals who are maybe hearing this for the first time. So I'll go through this as efficiently as I can. Credit Clear is an ASX-listed company that has commercially proven AI-driven technology platform that improves debt resolution. And whilst it's almost every other meeting that I hear organisations talking about their use of AI within their business, Credit Clear has been a pioneer of this type of AI within the credit collections place and across all Aussie fintechs for the last 5 or 6 years. And that's been proven by winning the award for best use of AI in a fintech in 2021, 2022, and being a finalist in 2023. We've also won a number of awards around innovation in 2023 as well, which I didn't put up there. We're an organisation trusted by thousands of clients in a highly regulated and diverse industry to engage millions of end-to-end customers. So we've got over 1,100 clients that engage us for their services, for our services, and 1.4 million active customers we're engaging with either digitally or through analog processes to help resolve their overdue account situations. We've got an environment where there's strong economic tailwinds supporting our industry, and there's been a consolidation within the competitive landscape, allowing us to scoop up additional market share in a market that's expanding rapidly as we see some of those factors driving through to higher default rates within not just our existing customer base, but the wider market. We're very much aligned with the rapidly changing behaviour of our clients and their customers. I was speaking to a shareholder very briefly about, the narrative around debt recovery used to be driven by financial goals. Now there is much driven by goals associated with engagement, treatment, and regulatory goals to ensure that not only are we managing our objectives of the customers that we look after in terms of their financial requirements, we're also managing the softer skills around the treatment of those potentially in vulnerable situations. So having a metric like the Net Promoter Score at a plus 41, having surveyed over 400,000 customers, is still an extraordinary high Net Promoter Score, and one that I know as a business our core values really aligns to. So we're still very proud of that, and it's something that is actually helping us win business. There's probably 2 slides around our business model. I think it's something that over the last 18 months since I've been in this role has been one of the points of discussion around how quickly do we bring a client to the table, announce it as a new acquisition, and what's the process at which where you start to derive and deliver revenue and profitability to the business. So as we look at this, there's a sale. The client appoints Credit Clear as a supplier. There's an onboarding process where Credit Clear and the client establish a two-way data exchange where we can receive customer files of overdue debt. Then the client can send those files in a data that we can absorb, and we can exchange back payment data when we've received payments, or when they can reactivate or unsuspend customer accounts who may have been suspended for, say, a mobile phone service. Then there's operations around Credit Clear engaging clients' customers to resolve accounts. And ultimately, any payments that were received into our trust account or into our bank accounts, we can audit them to ensure that we're sending the money back to our clients. So whilst it seems simple, there's lots and lots of moving parts to that process. And the larger the client that we're onboarding, typically the longer it takes to get that facility up and running and prove that concept. So that's the first slide. We'll there's a slide later that talks about the timeline associated with that, certainly from a tier 1 perspective. All right, so you're going to hear from Jason now, our Chief Product and Technology Officer. So welcome to the stage.
Thank you. We'll just do a height adjustment here. Here we go. Thank you very much, Andrew. So this is my favorite graph. And I'm a data guy, and this is my favorite graph. So this is the best representation we have of the impact that digital is having on the collections industry. This is a graph of pure digital payments or pure digital collections that are happening on the platform, where we've communicated out to customers, they've actioned the messages we're sending to them, they've come onto our platform, and they've made a payment or set up a payment plan without any human touch. And as you can see, we continue to hit records, hitting 9.6 million in October. It's the first month above 9, and continues a rapid and accelerating pace of digital collections happening. In fact, we're 26.4% up quarter on quarter. And as Andrew touched on, that whilst delivering an amazing customer experience, NPS of plus 41, showing that there's a lot of people out there that really love to engage with us on a digital digital means. So we hope to see the digital collections continuing to accelerate like this, and we like to see that for 2 reasons. One is that it's driving sales, because being the market leader in digital collections has become very important in the market. Our clients, tier 1 and in fact all the tiers of clients, are increasingly looking for organizations that have a strong digital capability. So that's a big driver. And the second driver is that it improves our operational efficiency as well. I'm really excited to share this information that we've been gathering on Armour for the first time. So 18 months ago, we invested in acquiring Armour, bringing the companies together. And we've been, digging through the results to have a look at what's been happening over the past 12 months. And it's very, very exciting. So we focused in on the Armour consumer division here. So consumer is the best place for us to be using digital. We're talking about high volume, low value debts to individuals. It is actually the largest division within Armour. And the figures here are probably the best representation we have that acquisition was exactly the right move for us to be making. And you can see the return on that acquisition. So in summary, we have increased in the last 12 months our revenue per agent by a staggering 47%. And that's been achieved we've had an increase in revenue of 50%, but only required an increase in the number of staff of 4%. And the reason we've been able to do that is because digital's doing a lot of the heavy lifting. And in fact, actually digital now accounts for about 56% impact on the payments that we're receiving in the consumer division. So that is a very, very strong demonstration of the impact that digital's having, and a really good lead indicator to increasing profitability for the company. As we see digital doing that lifting, and digital has an 80% GP, we anticipate seeing increasing profitability as we go forward. We also saw very encouragingly, the referral volumes increasing by 42% over that time, and actually the average debt value increasing, which are a bit of an indicator of what's happening in the market, the market forces around the pain that I think everybody's experiencing out in the environment. So great news for digital. On that, I will hand back to Andrew.
Thanks, Jason. I think there'd probably be a few people in the room that would say the best thing about the Armour acquisition might have been the quality of the management team. Few in the room, which might agree with me. Certainly very exciting to see those results flow through from the digital analysis that we've done. It is wonderful when you talk to shareholders or potential shareholders over the coming weeks and months, and you can really point to specific financial benefits around this digital transformation that's occurring in our industry. And to be leading that and be able to demonstrate through case study after case study that not only our clients' customers prefer to engage in a low friction digital method, while still having the opportunity to speak to someone on the phone that's based in Australia that they can get onto in a reasonable length of time. That narrative not only is driving our growth, it's driving our profitability, and it's certainly driving to achieve our objective of being, a leading debt resolution company. So it sort of lends itself to this slide. Why are we winning tier one clients? And for the record, we're classifying a tier one client that's generating over $500,000 of revenue a year. In terms of tier one clients that are active, we've got 15 tier one clients that are active, which is up 25% from 12 in FY23. ARMA has strategically positioned itself now as a key provider to Australia's largest companies. There's a pretty large chasm between being a tier two, tier three provider of debt resolution services to, let's just say, fintech lenders or tier two, tier three energy providers, and being appointed to a panel within a Big Four bank, a large insurer, a government organisation. However, ARMA has established itself as a really strong reputation within the industry, and supported by the Credit Clear technology driving digital transformation. Our tender success rate, once again, is over 70%. So where does that leave us in the future? I think we have well over 7 potential tier one clients that we've signed. And what I mean by that, we've signed them. We're forecasting in excess of $500,000 of revenue coming from them. So those analysts amongst you might say that's another $3.5 million at a very minimum that's going to come from those 7 clients. We would expect a lot more based on the opportunity and revenue forecast we have for those clients. But they're the leading indicators that we need to have to ensure that we're executing on our organic growth. So we've seen a material increase in the interest and new business success within the tier one clients. Whilst a number of the Big Four banks, Matt Common and Ross have said that there's not a huge amount of impact in overdue debts at the moment. That completely contradicts what we're seeing in the essential services space around energy, gas, electricity, and even rates. So the people that are experiencing an increase in, let's just say, negative cash flow, we're seeing translate into an increase in work that's flowing through to us from clients. This is the second presentation that I alluded to that talks about the life cycle of a client, where typically, and this is not a hard and fast rule, but to try and help people understand the life cycle of a tier one client, there is usually a 0 to 3 month. This is post signing an agreement. So there's lots and lots of time that goes into building relationships, presenting, submitting tenders before you get to this point. But as we know, the relationship really starts for our clients once we've signed a contract. So in the 0 to 3 months of onboarding, there's typically 3 to 6 months worth of an initial portfolio testing. And what I mean by that is, instead of us giving us 50% of the portfolio on day one, and there you go, it's around testing us on maybe a small sample size to ensure that we can absorb their data and we can, test the workflows that we've got in place, and in some respects demonstrate that we're going to deliver the results that we've, promised them throughout the sales process. Then there's a 6 to 9 months piece where we're optimizing the performance, and that's testing workflows, allowing our AI to determine a next best action to take throughout that workflow and really elevate our recovery performance. And what I mean by that is collecting more and collecting quicker. All right, they're the two things that are measurable typically from a client, whilst maintaining high levels of customer service and strong client engagement. Once you've demonstrated that proof that you are not only performing at the level that we've said we are, which is at the top level on a panel, and all the other metrics and KPIs are being met, we will typically get an increased share of that portfolio. We might go from a 10% to a 20%, or a 20% of the portfolio to a 50% portfolio, and in some case go from 50% to 100%. All right, so the larger the clients, typically they won't go to 100% portfolio. They need to have some supplier risk, but certainly a lot of the tier 1 clients that we're operating with, we're getting in excess of 50% of their work now that we've established ourselves as a top performing agency. All right, and that's what happens. The client reduces the number of suppliers provided on the panel. And whilst we've got a time frame of 12 to 15 months on this, it can be quicker than that or take longer than that. So if we go back to the slide before, we've got 7 clients that we've signed that are at some way through this process. We can see that the leading indicators that we've got flowing through give us, as a management team and a board, a real confidence that we're going to execute and hopefully overachieve on that guidance that we've provided earlier. I did talk a little bit about the macro environment, but sort of to narrow down and highlight just some of the key factors that's contributing to our growth, and hopefully build some further encouragement in the market about us as an organisation benefiting from some of those tailwinds. Having 5 interest rate rises in the last 12 months, with a cash rate increasing by 40% from 3.1 to 4.35, there's no question that's actually driven an uptick in the amount of files that are coming across. And we can see our clients and our prospective clients strengthen their bench in terms of collection solutions to provide and support them as we see each quarterly, electricity bill come through, and the default rates maybe on credit cards, insurance premiums, or in fact, let's just say, electricity bills suddenly start to increase. And they know and they're aware that they're seeing those early indicators and they're strengthening their suppliers to support that area. There's been much publicity around the mortgage and the fixed interest mortgage belt coming off, as in a step-by-step basis. There's still noise that inflation's really high and wage growth's really high, and there could be more interest rate rises on the horizon. I find it quite extraordinary that we're still sort of seeing record prices across the country in terms of property. But all that does is create an environment, I think, that Credit Clear is likely to benefit from. There's a key point that's illustrated in the graph over here around the percentage of borrowers in negative cash flow. This time last year, there was only 3% of individuals or households that were spending more than they were earning. To have seen that jump up to approximately 13% in the last 12 months just shows how severe the impact has been of inflation and interest rate rises on a significant proportion of the population. Tight labour market, as I said, full employment means that instead of bringing people in to solve this issue at a credit or collections perspective, they need to look at alternative options. And for us, we're very much championing the digital transformation component because it does 2 things. It's more efficient, but in terms of providing controls in place to ensure that you satisfy regulatory requirements, for example, like ASIC, who want to ensure that you're treating the vulnerable customers in a compliant way, you can point to the fact that we've got a solution that is specialised to determine and deal with that regulatory requirement in a way that you can actually audit and prove that you're compliant. So we're definitely seeing more interest in that from that perspective as well. Yeah. So we'll go back and whilst the ink is only just drying on the contract and with the partnership with Thriving Communities, it's an organisation that's in existence to support credit providers through the challenge of dealing with the financially vulnerable and the just overall vulnerable clients. And seeing that there's an increase, of 13% of customers in negative cash flow across the community, there's recognition that there's going to be more people that not just won't pay a bill, but can't pay a bill on time. And to have partnered with a leading organisation that supports not just Credit Clear's clients, but almost the whole of the banking and finance and the utility sector. To have partnered with Credit Clear as the first organisation involved in debt recovery, is a testament to the fact that we stand for, helping people resolve debt in a better way. That we've been selected as the first partner in this particular space. So watch this space. There'll be an announcement, but it's worthwhile mentioning now. I also touched on this earlier around the competitive landscape. Not only have Credit Clear established ourselves as a tier 1 collections and software provider to that collection space, the opportunity has increased for us due to a lot of M&A activity having happened. One that I've talked about on a number of presentations is the Milton Graham merger with Recoveries Corp. They were probably the two largest contingent collections agencies offering traditional analog solutions to clients around debt recovery. Bringing those two organisations together has certainly opened up opportunities for us to step onto panels that were maybe quite secure. So we're seeing more opportunities come through there. Collections House, having been previously a listed organisation going into administration and then acquired by Credit Corp, means that organisations who want to utilise a service provider that doesn't acquire their debt, has created some opportunities for us, ones that we're benefiting from as well. I won't go into too much detail into some of the others, probably because we're quite friendly with them. But we want to make sure that there's certainly a lot of change in this industry, and when there's change, there's opportunity. And I think that Credit Clear are the best position in the market to take advantage of that opportunity. So a quick outlook. I've talked about macroeconomic tailwinds enough. I think Australian companies are preparing for a deterioration in the economic environment. They're strengthening their suppliers in its space. We're currently in a sales process with several potential tier 1 clients, as I said earlier. We seem to be highly regarded, not just in terms of our performance, but in terms of our approach, not just this digital approach, but the approach that actually holds a Net Promoter Score as one of the leading indicators that we look to in terms of performance. So board changes with ESG, and rather than focusing on just financial goals, supporting financial goals with very strong customer service and engagement goals as well. Continued integration of the software as a service platform across third-party contingent collections teams, driving performance and gross profit margin uplift. Whilst we are still seeing the opportunity to expand our footprint within the credit and collections space as a third-party collector, we've actually never seen as much interest in our software as a service platform. And we look to grow that component, build a relationship with a client in sometimes that third-party space, prove out the value and benefit of the software as a third party utilised by the Armour Group, and then upsell it as a software solution, and potentially a first-party software solution where our clients can utilise that technology on a software recurring revenue model, licensing model or fee-for-service model, and integrate that within our clients' platforms and make it very sticky. So building a strong pipeline, strong potential for margin growth on consolidated cost base, and based on our expectations for our customer base and economic conditions. This is very important. Mostly the investors is that we clearly feel that the guidance that we provided at the beginning of the year, we're very much at the top of that guidance. So we'll be looking to achieve, that $41 million in revenue and that $2 million in terms of profit. So, whilst we're heading into, Q2. I hope to be sitting in front of you in the new year and giving you some improved guidance. So I'll finish there. Hopefully the CFO doesn't look at me too badly, but that's about as strong as I can say. Thank you, everyone.
Let's get the CFO up and questions from the room. Question about pricing. Traditionally, debt recovery is by the asset, and in certain markets have different pricing. How does that pricing affect your pricing in terms of going through the cycle that you and how you renegotiate pricing on the debt that you're
So very good question. I'll repeat it for those online. The question was around how we price, and there's different pricing models for different components of our business. So we look at the software component. That's typically priced on a license fee or a fee per file or a fee per process. So it's pretty straightforward. It's quite fixed, and it doesn't really matter in terms of the fluctuations in terms of performance. The majority of our business revenue is priced based on commission revenue. And whilst we don't buy debt, so we don't need to worry about pricing the debt today, and that debt may perform very differently tomorrow or next year or the year after. We're able to price a portfolio, whether it be on a tender for 3 years today, and that could be based on a projected recovery rate, and you can model out your gross profit margins from that. Now, if there's huge deterioration in recovery rates over the next 2 or 3 years, we have the ability to go in and negotiate with that client to increase our recovery rates or increase our commission rates. Or in reality, if we're collecting a huge amount more and inefficiently, then they might come and negotiate us to lower our commission rates. So the best way to explain it is that there's a mathematical model that looks at the average debt value times the average recovery rate times the commission rate equals the margin that you have per file. So as long as that's well and truly above your cost to recover that file, we're heading in the right direction. And perhaps there's a future question that looks at gross profit margin. And I know that Victor, our CFO, will be able to answer that, saying, look, at least every dollar in revenue that we're looking to add moving forward, we're looking to add over 50% of gross profit margin to every dollar dropping through the bottom line. Michael? It's a couple of Michaels. He keeps quiet in these things. Nothing online?
We've got a few questions from online. And the first was about, so what is the biggest headwinds facing business in terms of margin leverage? Just making the point that Armour's got impressive leverage. How quickly can it scale from here, from this 40 million investment?
Yeah, well, I'll talk about probably one of the bigger headwinds is around the increased investment in compliance around data security. We've had to invest significantly for 2 reasons. There's a change in the expectation from our clients and the environment in general associated with data security. So additional controls, additional software licensing, additional focus in terms of people and resourcing. At the same time, we've established ourselves as a tier 1 provider. So we've had to increase our team in that area as well. The second, I think, headwind is potentially as we expand and we need to find people to work for us. So a very tough employment environment means that finding good quality people, training and retaining great people is certainly a challenge. And whilst the case study that Jason shared earlier in terms of, only needing to expand the consumer team by 4% from a headcount perspective is great, retaining and attracting that headcount has still been one of the biggest challenges in this current environment. Victor, have you got anything to add or Jason?
I'll add a little bit. So you've spoken about headwinds, Andrew. I'll talk a little bit about how quickly we can do that. in order to try and assist with the forward-looking aspect of your question, we'll just go back a year to the $35 million we generated in FY23. You can see on the screen there, we're heading towards the top end of that revenue range of $41 million. So that's a 17% or so increase in revenue. So if you're looking forward, I'd like to think we can achieve at least that, remembering most of that increase is organic growth. We've made a smallish acquisition recently. We'll continue to seek out opportunities there. But if we take $41 million as a base, add 17% or thereabouts, we're getting close to $50 million, okay? So with that, as Andrew's alluded to already, we expect 40 to 50% of that revenue growth to drop through to the bottom line. That's where we start to get that leverage that shareholders and management are looking for. You know, we strongly believe we're at an inflection point at the moment. I think we've just got to remind ourselves the last 18 months has been making the Armour acquisition, bringing them on board. We've gone through integration challenges, be it system and people. So we've got that 90% complete. Our offices have been set. We expanded our Sydney office to take in growth. So that expense is there. Tech hosting, we're working our way through that, but you know, we're a large part of the way through most of that integration. The point there, though, is I expect fixed expenses to remain relatively constant to where they're at the moment, okay? Tie that in with that 40, 50% flow through from additional revenue to the bottom line, that $2 million quickly becomes $6 million based on that formula, all things remaining constant into FY25. So that gives you an indication of what's going through our minds and our strategies and decision making beyond this financial year.
Next question online was just regarding the Big Four bank. What's the update in where we are on boarding them?
Well, lucky I've got a couple of the GMs in the room. I can ask them how far away we are. But last I was told is that testing, in terms of that 0 to 3 month testing component, is to go live next month. Now, whilst we've been audited in terms of data security more times than any other organisation, I think that we're getting at the end of that component of the onboarding process. So whilst we're getting very close, I don't suspect we'll see a huge amount of additional revenue in this financial year. But what that does is almost proof concept that we're able to onboard a Big Four bank, and we're in processes with 2 other Big Four banks at the moment. And doing it a second and a third time, you've got all the material and all the processes there ready to go. So the onboarding and scale up for those organisations, if they go with us, should be much more shorter and more efficient.
Question on the acquisition. Is the acquisition of the DRA completed in the database?
No, it's not. We haven't completed the acquisition quite yet. On the 30th of this month is when we're due to complete. So having that, or at least 7 months worth of revenue and earnings coming from DRA should be an improved, certainly in terms of us meeting that guidance or potentially exceeding it.
And then just in terms of the M&A strategy moving forward, what are the acquisition criteria that you're looking at? Is it return on investments, multiple ranges, etc.?
Yeah, I think like a lot of the fund managers or shareholders I speak with, being immediately cash accretive, so not chewing cash from operating activities out of our business is critical. Looking for synergies within our sector. So if we're looking to buy a traditional collections business wanting to elevate their business and capability through digital transformation, that's critical. But slightly outside of that, simple acquisition, we're looking at maybe value adds and bolt-ons which diversify our offering slightly, but not too differently. And that could be in the, let's just say, the payment space, It could be within the space of, data, so we can overlay and enrich and use that, 1.4 million customers that we're engaging with and enrich a database. So we become an organisation that's not just around, collections. We can provide insights to our clients on behaviours and data. So, whilst there's some simple criteria that we have in the M&A committee around, in helping us grow quicker, but also continuing to differentiate our capability from our competitors.
All right. Just in terms of the competitive competing against other agencies on a panel, how do you go about convincing your customers that you're going to do a better job than existing providers?
Well, look, one way is pointing to our experience with their competitors and how we consistently are number one in terms of agency on a panel. So that makes it easier and easier as we go out to other organisations operating in the same space, where we can show that their competitor had brought us onto the panel 6, 12, 18 months ago, and we're consistently leading the panel in terms of recovery rates, speed of recovery, service, net promoter score. And that not only just generates extra work with those existing customers, but it makes it a lot easier to win new customers as well.
Question about international.
Yeah.
Is international still part of the plan and the journey?
Yeah, look, it certainly is. I think during that, correction where we'd proven that we could deploy software in South Africa, I think just under a poor commercial model, that filled me with encouragement that if it's the right opportunity, and that opportunity could be with an existing customer that has relationships in the US or the UK, or within a client that we've identified through some of our partners operating in those spaces, we'll definitely invest. And I'm not necessarily sure on the structure. Partnerships might be the right structure. It might be an acquisition or a beachhead straight over there. But what would be ideal, for example, could be an established traditional collections business in one of those markets that has really strong relationships, like the ARMA management team recognise the need to transform analog processes to digital and leverage our digital capability, overlay it on their relationship and management, and then almost replicate the model that we've done in Australia. So still remains very, very much part of the strategy. I think we just had to get this house in order in Australia first.
Returning to pricing, maybe the last question from online. What percentage do you think this will push forward without affecting business?
You're talking about how we price. Look, the good part about it is that we're pricing against organisations that have traditional cost bases associated with recovery. So if we can maintain at least the same pricing level as our competition, and in reality, we're actually pricing ourselves at the very top of the panel because of our strong belief in an Australian-based servicing team, an Australian-based technology team, and confidence behind our recovery rates. We've been able to stand strong in terms of our the way that we've priced in the market. We're certainly not an organisation that's trying to undercut and win business through price. We're winning business based on value.
That movement to customer experience.
Yep. Yeah. Look, supported by the experience, which is clearly becoming more and more important to boards and management teams of our clients.
How volatile is that pricing?
It's actually pretty stable, and I've had a number of conversations, not just with our clients, but some of our competitors, just to say, perhaps as the quality of debt deteriorates and it becomes harder to collect, there could be an argument to increase prices. But certainly collections teams across the clients that we're engaged with are quite focused on maintaining their budgets around what they spend in collections. And, you know, there's a couple of other factors. We're seeing the average dollar value of debt increase as well. So even if you're charging the same commission rate, let's just say 10% of $1,000, it's almost the same work to collect a debt at 10% at $1,500. So the margin that you're getting out of those accounts can still be improved, even if there's some downward pressure on recovery rates.
We can wrap it up there unless there's any other questions from the room.
Well, thank you very much. I appreciate certainly Jason and Vix's input, and we'll no doubt keep you abreast of our next announcement.